Alright, welcome back to my YouTube channel, where we talk about all the good stuff, like finance, investing, and trading stocks the right way. Today our topic is what stock valuation is, understanding the premise for the existence of valuation, and an overview of different valuation models. Many people may feel that valuation is very mysterious, or that it is especially difficult. As for how much reference value it really has for our investing, there is quite a bit of confusion. So today, I will, in an overview style, introduce some of the thinking behind valuation. Now, in this episode today, we will not involve more of the specific uses of each valuation model. I will do that later. In later episodes, I will gradually take out the specific use of each method and explain them in detail. Today is mainly to provide an overview, so that in the future, when you use these different valuation models, you can know how you should understand the meaning behind valuation and how it guides our operations. At the same time, what risks there are within it. Alright, first let's understand what valuation is. In fact, valuation is a comprehensive analysis of the financial condition of a company that can operate sustainably in order to determine the company's intrinsic value. It roughly estimates how much the company ought to be worth. It is a foundation for our trading and pricing. Of course, the premise is that you are practicing what is called value investing, or a price-based investing approach, in order to use valuation. If you yourself are a purely intraday, short-term technical style trader, you may not need to consider too much the question of whether valuation matters, because in many cases, the price expression and trajectory related to valuation will not play out within 1 hour or within 4 hours. Therefore, when we discuss valuation here, every time we say this concept, we are referring to those who hope to understand the intrinsic value of companies and use that as an investment reference. Alright, this is a very simple concept. But after we understand this concept, we need to extend it and know the essence of trading stocks. That is, if we trade based on valuation, what should be our essence? First, the premise of all trading is to assume that there is a spread between market price and intrinsic value, which is the valuation we just mentioned. This spread may be high or low, but it must exist because only when a spread appears do you have the premise for a trade. If valuation and market price are exactly the same, you basically have no so-called trading opportunity. Alright, this is the first thing we assume, that there is a spread between market price and intrinsic value. Within this, its essence actually divides into 4 types. After you realize there is a spread, the first situation is that when you invest in a company's shares, you actually become a shareholder of the company. You hold the company's stock and enjoy the equity gains brought by the company's growth. This is what you are doing in stock trading. You say you buy this year and plan to hold a stock for 3 years. In reality, you are waiting for the growth over the next 3 years to bring each shareholder an increase in earnings, per share, book value, and equity. And that is your first way of thinking and method of trading. You are trading for future growth. The second method is that, in reality, besides the company's intrinsic value, you may also consider the overall market's volatility, or whether current market sentiment is optimistic or pessimistic. You combine this with market price and company value, that is valuation, to make a comprehensive assessment. What you invest in is the price deviation driven by market volatility relative to valuation. This is the second essence of stock trading. The third is that you invest based on the discounts and premiums created by certain mispricing behaviors and their differences from valuation. Many times we say a stock rises in an extremely frenzied way, or falls in a very unreasonable way. Inside this, there may be mispricing. If it is mispricing, then the price rises very fast, right? Suppose its fair value is $60, yet the market agrees it rises to $180. What is this called? This is called a premium. If the thing should be worth $60, but it is trading at $40 and people are still selling, what is that called? That is called a discount. This situation may be caused by certain reasons that bring mispricing. And what you trade is the spread between this mispricing and the value it ought to have at $60. This is another way of thinking you should consider when stock trading. Is there anything else? There is another one, which is when you invest based on macro fundamentals. For example, monetary policy bringing certain changes in asset prices, such as easing by the Federal Reserve bringing expansion in fiat money, and an upturn in inflation. What does this bring? It brings an expansion in asset prices at the same time, because behind all asset prices, we still speak of business operations. When inflation in the money supply appears higher than in normal years, companies usually raise prices for their products accordingly, and the magnitude of these price increases usually broadly aligns with the pattern of inflation moving higher. In reality, the so-called growth of companies is, in essence, merely the increase in face value or book value brought by inflation. If you invest based on macro fundamentals, for example, many people hold stocks as a way to appreciate or preserve value than what you call value preservation, compared with holding cash, is this. Cash sits still. Bank interest compared with inflation is often lower than inflation and cannot beat it. So you invest in stocks which, because of dividends and their gradual rise with inflation, can offset your cash devaluation or offset a portion of it. This is investing in macro fundamentals. In sum, these four different essences of stock trading all internally require valuing companies. You must know that a spread is produced here, and you must know the reason for its spread, whether it is driven by growth, by sentiment, by mispricing, or by macro fundamentals. After you know this, you will know, okay, how you should invest in its value and look for its spread. All right, these are some things we should understand before valuation. Now, regarding valuation in the market, many people hold many opinions, just as when we usually talk about technical analysis. Fundamental analysis and technical analysis both have completely opposite views. We have spoken before when discussing technicals that many people think technicals are completely useless, and many others think technicals are extremely useful and rely on them excessively. Both are incorrect. It is incorrect to say they are useless, and it is also incorrect to rely on technicals alone while ignoring other factors. In stocks, the same two opposite views exist regarding valuation. Let's talk about the logic behind them. First, the first view is that stocks themselves are unaccessible in terms of valuation. That is, they think any company is unaccessible. The main theoretical basis is that no method can accurately assess what a company ought to be worth, especially compared with the market price, whether it is currently high or low. Why? Because business conditions change, risks are uncontrollable, and the future is unpredictable. No matter how past results looked, they cannot represent future certainty. Using today's data to extrapolate the future is absurd. Even when a company gives forward guidance, it cannot guarantee that the guidance will always be achieved, because guidance is usually accompanied by disclaimers at release. In fact, when we usually read financial reports, we will find that even if guidance is given, what happens by the next time? They either raise guidance or cut guidance. What is this? This is the constant revision of previously stated expectations. The changes behind those expectations are market risk. So the view that valuation is unaccessible or unconfirmable, does it make sense? Of course it makes sense, right? It is indeed very reasonable. If you believe valuation is like this, then you can stop watching the rest, because you do not believe valuation has any role, so you can completely skip it. However, I think it is like technical analysis. Tools are what we use to defend ourselves in markets. Showing up to a high-stakes competition with bare hands and no gear gives you low odds. If you show up with proper equipment and training, say a helmet, pads, and a playbook, you are not guaranteed to win if the opponent plays flawlessly, but your chance of avoiding costly mistakes is higher. This is why we learn tools. Therefore, we should not grab something and dismiss it in one breath, nor should we put it on a pedestal. Valuation is the same. This first view says it is unaccessible. If it is accessible, how do we understand it? Suppose it is accessible. If you suppose valuation can be judged, then what do we assume? We must assume some financial markets are efficient markets. I have discussed the concept of an efficient market in other episodes. You must believe the market is efficient. But many markets, because their histories are short and regulation is relatively loose, are often inefficient. I will not elaborate. Let us still assume that if you are going to value, you must do it in an efficient market. For us stocks, everyone now generally considers it an efficient market that is widely recognized in history. Most of the time, such efficient markets follow a certain pattern, special periods of distortion and abnormal behavior. For example, in January of 2022, due to supply chain disruptions caused by the pandemic and inflation concerns, global assets experienced large volatility. At that time, it was a chain reaction caused by a sudden change in macroeconomic expectations. It had nothing to do with all technicals or all fundamentals or valuation. It was entirely due to a short-term upheaval in the macro environment, like a car's engine management system suddenly going out of tune, and the vehicle could not be adjusted properly for a short time. The misalignment causes the whole system to misfire, producing secondary issues. That is what happened in January of 2022. And it was short-lived. Later, a skilled mechanic retuned the engine. The system returned to balance, and the market gradually returned to a normal state. Therefore, distortions in special periods are not the norm. We should not overreact to them, nor should we use occasional anomalies to deny the general laws of business development. But even when we assume market efficiency and accessibility, we must also acknowledge that no valuation method can precisely and flawlessly determine a company's true intrinsic value. Valuation can only be one of the references for investment decisions, not the entirety, because valuation itself can be updated and changed. Right? Investment bank analysts, who issue ratings 4 times a year, often change future target prices and upgrade or downgrade. Also, with each quarterly report, individuals update valuations based on new financial conditions, and many valuation data websites publish updates monthly or even more frequently. What does this represent? Valuation itself is a variable thing. Alright, after understanding the two opposing views on stocks, we know this since we are going to use valuation, we are expecting to use the second assumption, that it is accessible, if we are going to price and trade based on equity valuation. And we believe valuation has a certain role, then we still need 2 premise assumptions. The first is that a company's value must be measurable or calculable. How do we understand this? It means that company value can be measured objectively through a series of financial data using methods that have been verified many times by predecessors, and that these methods work most of the time and can be learned and mastered by you, not some hidden or rarely used methods. This is the premise that enterprise value and valuation must be calculable, that is, quantifiable. All right, then the second assumption is the concept of value reversion, that no matter how far the market deviates, no matter how far market price deviates from intrinsic value or valuation, whether above or below, the market price will eventually move toward intrinsic value and valuation. That is, it may be that valuation is $60 now, but the market price is $40. Well below it, you should believe there will be a value system reversion, and in the future it will revert toward about $60. Or if the price is now $60, it will in the future fall back near $60 if it is above that value. This is the value reversion we should know. How do we understand it? I am speaking from the angle of going long companies. I am not discussing shorting or selling. Only buying. The first case is that corporate results trend steadily higher, yet you believe the market price is far below the forward value. Suppose you assess current value at $60 and you see steady upward momentum in the business. Through a series of calculations, you believe that in 1 year the price can reach $70. You consider buying at $60. Now paying the time cost of 1 year to wait for the forward value to revert upward to $70, from which you might gain $10. What is this? This is buying the forward target, buying the future value reversion. This is one way to buy. All right, the second way talks about risk, namely the cost of time. It can range from a few days to several years. Perhaps you buy at 60 expecting it to reach 70 within 1 year, but it reaches 70 in 1 week. You are there, right? Then your expectation becomes something else. Will it reach 100 in 2 years? Your expectation expands. You then have 2 options, either wait and continue to hold, watching whether the market gives you in 1 week the price level that is the first type of time cost scenario. It may also happen that you buy, and after 1 week, even though you expected 70 in 1 year, overall sentiment turns poor, and after 1.5 years it is only 59, 1 less than when you bought. What is that? That is your time cost. It might not revert in 1 year. It might revert on day 1 after 1 year, or 1 month after 1 year. By then, you might not have the patience. Either you leave or you use other methods and do not capture the gain. That time cost is what you must bear. This is your risk. The second risk is whether the company's promised growth can be fulfilled. Some companies give forward guidance that they can achieve, say 15% annual growth going forward. Perhaps they hit it in the first 2 years, but in the last quarter growth drops to 7%. Clearly, they did not fulfill the growth promise. Then the target you set a year ago, that it could reach 70 in a year, may not be realized. This is also your risk. Yet we are still assuming value reversion. All right, another way is due to mispricing from various market reasons. The stock keeps falling and is sluggish. You judge that the current market price is below the current intrinsic value, below its valuation. Suppose valuation is 60 and the price drops to 40. You say this is mispricing caused by emotion and fear spreading, by people misunderstanding financials or overly amplifying fear. You think 40 is worth buying, so you buy, then wait for current value to revert. The current value is 60. The forward value you think reaches 70 in 1 year. So buying at 40, you can target 60 and also 70. This is a kind of buying low, but the same problems exist. Mispricing is usually caused by short-term major positives or negatives. For instance, some piece of news suddenly pushes the price sharply up or down. Will that positive or negative evolve into a long-term fundamental driver? Are you mistaking a fundamental reversal for mispricing? In fact, could what you call mispricing actually be correct pricing? This is your risk. You misjudge the market. What you regarded as a short-term negative might ferment into a long-term risk event that accompanies fundamentals for many years. In that case, when you bought the dip or tried to bottom fish, you bought too early or bought wrongly. This is the first common situation. There is another very common situation. Many people buy cheap falling stocks and keep buying more as they fall, or judge something as worth buying simply because the sticker price is low. In truth, high or low price is not measured by the face price. A stock at $60 per share versus a stock at half a dollar per share, which is more expensive, which is cheaper. Many would say the $half one. I am telling you that is not necessarily correct. You cannot directly say that a $half stock is cheaper than a $60 stock. The $60 stock might have an intrinsic value and valuation of 90, so compared with its own intrinsic value, it is quite cheap. The $half stock might have an intrinsic value of 0 or negative, which means you lose once you buy. Its valuation is deeply negative and cannot be realized. It may even be overvalued by a factor of 10. Is half a dollar cheap? It is not. Therefore, when you bottom fish certain stocks, you must know what they should be worth in the future or now. Those numbers are not imagined. They come from calculating using some valuation framework. You can use your own framework, or use someone else's framework, or one that others calculated and shared with you, but you cannot have no framework and no comparison. Otherwise, you cannot judge whether a price is cheap or expensive. $60 versus half a dollar, which is more expensive and which is cheaper, is not easy to answer. This is a critical issue. If you mistake cheap and expensive, treating face value cheapness as real cheapness, you may frequently buy things that continue to fall. Falling again and again. Why do some growth stocks behave like this? Because when valuing growth stocks, valuation is based on forward targets. They are not making money now, so it is difficult to say exactly what they should be worth now. And because quarterly results may vary dramatically, their valuation can deviate widely from quarter to quarter, swinging violently. In such cases, a stock you thought was worth $20 per share this month may be worth only $10 next month. Then, the $20 you paid last month was expensive, and $10 now seems reasonably cheap. But next month it may again be not cheap if results deteriorate. Losses persist and losses widen further. It might be worth only $6. This is why people often make mistakes trading growth stocks or stocks with unclear valuation. They think the more it falls, the more they should buy, averaging down. They say they believe in the future, that they have confidence. When others ask you where your numbers are, you must be able to answer how much you think it is worth and why. If you say it is worth 60, Why is it worth 60? Then you say because it has potential. How much potential? What are the numbers? What is the market share? What is its profitability? What is the level of capital expenditures and investment? And in how many years can it turn profitable? What should the average earnings per share be? Compared with peers, is its revenue generating capability strong or weak? You must have these so you can have a valuation, right? Then you can genuinely recognize it rather than relying on hot-blooded conviction or echoing others. If others say it is good and you follow, you risk being led by the crowd and becoming a casualty of narrative. So do more of your own research. These are several preliminary assumptions about valuation. After this, I will list several common valuation methods briefly. After listing them, I will in future episodes explain in detail how each is used and what variations exist. First, common valuation methods fall into two major categories: relative valuation and absolute valuation. In relative valuation, there are many methods. In absolute valuation, there are fewer. Let's briefly go one by one first. In relative valuation, the most popular is the P/F method, also called the price-to-earnings valuation method. It is determined by the ratio of stock price to earnings per share and is widely used. I personally also use P/FE, but with some adjustments in my approach. Simply put, P/FE is price divided by earnings per s-hair. Many people take price, say today's $60, and divide by EPS from the past 12 months, which is 4 quarters, and get the P/FE. Then using P/FE times earnings yields what the stock price should be. This is the basic method, but there are variations in which inputs you choose and how you choose them to be more reasonable, adjusting with the market. I will explain those adjustments later. The second method is peg the price to earnings to growth method, which refers to the ratio of P/FI to earnings growth rate. This is also a common relative valuation method. The third is P/FI, or price to book, which is the ratio of price to book value per s-hair. It applies to some companies, not all, more on that later. Another is P/FAs, price to sales, the ratio of price to sales per s-hair. It can be used for some companies. Then the fifth category is EV/EBITDA, the enterprise value multiple method, which can also be used for relative valuation of a company. These are the common relative methods. Each has its own use cases and strengths. Some are easier to use and some are relatively simple. In future detailed explanations, I will talk about their trade-offs and where they are suitable for typical company types. After that comes absolute valuation, which everyone often sees. In the previous episode, when we talked about investment bank analysts making market projections, their analysis often used the valuation method called discounted free cash flow, or DCF. This refers to discounting the free cash flows a company will generate over many future years at a reasonable discount rate to obtain its present value. This is a widely used absolute valuation method. Whether it can more accurately reflect a company's value is debated. In reality, every valuation method has advantages and disadvantages. But let's return to what I said at the beginning. Regarding valuation, do not treat it as your only strategy or tool or as your sole reference. It can only be one reference among many. Just like we said about the more important technical analysis, using methods together is what makes them useful. Alright, this is what I wanted to explain today. Some background knowledge about valuation. I want to make it clear so you can understand. Okay, after you value, how do you guide your operations and what referential meaning it has for your investing? This way you will not be so confused. Otherwise, when we later talk about various valuation methods, it is easy for people to misunderstand. That's everything I've got for you today. If you found this video helpful, make sure to like it, subscribe, and turn on the notification bell so you don't miss the next one. There's plenty more coming your way, so stay tuned, and I'll see you in the next video.